Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. Technology stocks have been all the rage this week, and everyone is talking about the Nasdaq and the sell-off and all the craziness in the US. And that is very important, but I've got to tell you that there is something else going on the other end of the world that is almost as important, if not more important, from a South African perspective. You see, when you are investing, you simply cannot afford to ignore macroeconomic risks, especially when they relate to a market the size of China. Long gone are the days of high single-digit growth in GDP in China, which at the scale of that market was enough to create a huge source of demand for products and services. Instead, we now find ourselves firmly in mid-single-digit territory, with expectations for this to drop to low single digits in coming years. There are still pockets of opportunity in China, like electric vehicles, and how the Chinese domestic vehicle manufacturer industry has become a real global threat to the likes of Stellantis and even Toyota. But in other areas like the property sector, the slowdown in China has been so severe that it has caused much pain in the likes of the steel industry. This has driven hardship at ArcelorMittal South Africa, for example, with that group facing an almost impossible situation right now of weak Chinese demand and the resultant pressure on global steel prices, with limited demand in South Africa to pick up the slack and allow the company to run at a profitable level. For companies and sectors exposed to China, the recent third plenum has done little to inspire much belief that government will prioritize economic growth above other plans, and goodness knows authoritarian, communist governments just love a good plan. All indications are that China will focus on becoming more of a technological powerhouse, which suggests that their domestic tech market will see extensive investment in AI and other areas. Western big tech unfortunately won't see much of this action because the Chinese are incredibly focused on being self-sufficient. I guess if you are really brave, you could have a punt at something like Alibaba. But that stock has lost almost 2/3 of its value in recent years after finding itself in the crosshairs of Chinese authorities, and therein lies the risk of investing in China itself. Clearly, the opportunities there aren't the easiest to access. You have to tread very carefully. Some even call it uninvestable. Frustratingly though, the fallout from the Chinese market is found in many places, so you can't really avoid the risk, but you also can't get much of the benefit either. For one thing, a slower growing China is a real problem for many commodities, which in turn is an issue for emerging markets like ours. China has been an excellent source of growth for other emerging markets, so that's a risk for a number of countries. And the impact goes far beyond commodities though, especially when you remember just how many consumers China actually has. For what is essentially a communist country, they sure do love their luxury goods on that side of the pond. A recent theme in the markets has been poor numbers coming out of luxury groups that are highly reliant on China. So think Richemont, for example, LVMH. It's not just luxury though, with many premium brands also taking a knock. Now, whilst it is true that the rich stay rich regardless of economic pressure, it's the way in which they show that wealth that varies and what they spend their money on. When the government is focused on common prosperity, it really isn't so fashionable anymore to arrive in a brand spanking new Rolls-Royce. BMW Group just released its results for the second quarter, and Rolls-Royce unit sales were down by a whopping 16% year-on-year to 1,294 units. Over 6 months, sales were down 11.4% to 2,819 units. Whilst the report is devoid of any references to China for Rolls-Royce specifically, they do mention that vehicles priced at 40,000 euros or less were the majority of growth in China. Never mind Rolls-Royce, that rules out basically all but the most entry-level vehicles in the BMW Group stable. And that tells us a lot about what's going on in the upmarket space, not just the luxury space. Over at Ferrari, we have another useful data point because they give very helpful, specific disclosure on China. For the 3 months to June, they sold 200 cars in the country, a substantial drop of nearly 25% year-on-year. For context, Ferrari as a group sold 3,484 cars in the quarter, so China was 5.7% of the group total, and that is significant. The difference here is that Ferrari as a whole still grew its unit sales by 2.7%, and because of their incredible pricing power, they grew revenue by 16%. So Ferrari is not exactly struggling, and they can very easily redirect stock that was destined for China to other markets. There's always much more demand for units at Ferrari than supply, and that is a deliberate decision they make. None of the other manufacturers are in that position, unfortunately, and especially not with that consistency, which is why what's happening in China is far more problematic for the likes of BMW than it is for Ferrari. And that's probably why Ferrari's share price is up 167% in the past 5 years versus a rather sad 25% total increase for BMW over the same period. I'm quoting the tickers on the US exchanges in both cases there, so they are directly comparable as both are in dollars. Let's do one more before we move on from motor vehicles. Porsche, or Porsche if you want to be fancy, which has the beautiful ticker P911 in Europe, and that must of course be pronounced P911. In the US, there's an ADR as well, so we can quote a dollar performance here, but we can't do it over 5 years, unfortunately, because the IPO is far more recent than that. But over 1 year, the share price at Porsche is down 40%. BMW, that's down 22% over that time. Ferrari is up 36%. Don't mess with the Italians when it comes to supreme luxury. In the first half of 2024, Porsche increased group deliveries by 21.6%, but deliveries to China were down by 32.6%. That is a huge decrease. Unlike Ferrari and certainly Rolls-Royce, Porsche is not really a flashy display of luxury, let's be honest. Many of the units are SUVs for upmarket consumers, but by no means the super wealthy. And this is where we see the true economic pressures in China coming through, with upmarket customers, the same ones that BMW is trying to sell to, pulling back. That's enough on cars. What about much more affordable products, like coffee? Well, for that, we can look at Starbucks, and I'm afraid you might need a double shot to get through the pain of these numbers. For the latest quarter, comparable growth in China is down by a pretty awful 14% at Starbucks. They are facing a competitive market there, and consumers are under pressure as we've discussed, which inevitably leads to a price war on what is effectively a commodity like coffee with easy substitutes from other brands. Local brands and more value-oriented offerings don't need much creativity to be able to just undercut Starbucks on price, leaving the iconic American brand floundering. And to make it worse, Starbucks has been in China for 25 years now, so it's not like this is new territory for them, it's just a new environment. Starbucks in many ways is perhaps the scariest of these examples that I've given in this podcast. Long story short, be extremely careful of look-through exposure to China in your portfolio. Just because you don't own Chinese equities doesn't mean that you aren't heavily exposed. The technology businesses in China, they seem to still be doing okay at the moment, and what government is saying does seem to support investment in that space. But consumer businesses are taking immense strain. Go into the detailed financial reports of the companies you're invested in. Find their transcripts, search the word China, and see how much they disclose. Then see what portion of profits come from China, if that is disclosed, and take a view accordingly. That wonderful American or European brand that you bought might really bite you, and for reasons totally unrelated to the great experience you had with the product on your recent travels to a Western market that encouraged you to buy the share in the first place. In investing, it's all about the detail and a strong appreciation for the world of macroeconomics and geopolitics. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.